Okay, hello everyone. Warm welcome to you all in the session of Oliveboard. Good evening to all. So those who are watching, please confirm my audibility and visibility. Everything is fine, perfect. Can we start today's session? Okay, I hope everything is fine. So yes, what we have to start, we have to start a very new unit, that is unit number 16 of module C, special cases of valuation. So yesterday's class we completed our non-discounting techniques, non-discounted cash flow techniques for the valuation of the firms. Now, special cases of valuation. What are these special cases of valuation? See, if you want to purchase any business which is related to intangible in nature, okay, who is dealing in intangible assets, or any business who is the loss bearing business, okay, if any investor wants to purchase such type of business, then the valuation is done on the basis of some special cases. So the cases which the valuation is done on the basis of such categories, that is known as the special cases. So special cases are what? The intangible assets, the loss bearing business, okay, trademarks, patent, intellectual property rights. So these are what? The special cases. And for such type of business, the valuation is to be done. So hereby the unit is special cases of valuation. Now, how to do the valuation of such businesses if it contains all the trademark, copyright, IPR? So, the intangible assets, first, let's understand what are intangible assets. Intangible assets are those assets which cannot be seen and touched, like patents, copyright, franchises. If you have taken the franchises like Domino's, any Pizza Hut, so there are franchises in different states. The data of the customer, any kind of software, trademarks, goodwill, reputation, brand, okay, recognition. So all these are what? All these are the intangible assets. If anybody is related to such business and they want to sell their business, so how a purchaser will value such type of business? That is special cases of valuation. So special cases of valuation, there are different approaches. First is capital investment. Second, we have seen discounted cash flow DCF, and third, relative valuation. Again, relative valuation means comparable business. Okay, nearest competitors business, we can say. Now, capital investment is what? Capital investment, it refers to the total amount of money a company has spent on an asset over time. See, capital investment basically means what? There, any business organization is consist of their assets. So definitely they have their tangible assets, intangible assets. So if company spends any kind of money on its repairing of the assets, on the purchase of its assets, okay, on maintenance of such assets, so that is done what? That is done a type of investment. So we cannot say that it is an expenditure. Rather, expenditure, we use the word that it is an investment because you are repairing your assets. Okay, you are making your assets to work at a very, you can say, high cost. You are purchasing any new asset, you are replacing your old asset with a new one. So definitely what is you are expending over that, it is known as what? The capital investment. So the more you will spend on your assets, the more it will create the value, the more it will create a brand. So, for example, to estimate the value of a brand, you would look at how much the company has spent on its advertisement. So, definitely, if the company has spent more on advertisement, okay, so it has generated more income, okay, it has generated more goodwill, more reputation, and if there is everything more, then definitely the valuation will also be. Yep. Then calculate remaining value of those advertising expenses. So the expenses which you have done to attain your assets and the expenses which you have done on advertisement. Okay. So this is what these are the type of expenses done in case of capital investment. Now, discounted cash flow valuation. So first we have to estimate what the discount rates. Okay. If in this we look at how to measure key factors like risk free rate, beta, and the risk premium to estimate the cost of equity. So first, what we have to do, yes, we have to estimate the discount rate that we do na. If we follow the discounting technique, we take na 10% at 10% discounting, at 20% discounting. So how 10% discounting is done? Like 110 at, if I say at 10% discounting, it means 1 upon 1.10. Clear? Now do equal to sign. Clear? Then do M plus. Clear? Again do equal to sign. So for second year, we do equal to 2 times, then M plus. If we have to find the uh, discounting for the 5 years, so we do equal to sign for 3 years, then equal to sign for 4 years. Again do M plus, then equal to 4 times to equal to, then press M plus on your calculator. Then do equal to 5 times, then do then press M plus, and after that at last, because if the question is asked for 5 years, you will press equal to 5 times. If in the question it is asked to calculate the valuation, the discounting for 4 years, so you will do equal to 4 times. And at last, when the last year it is being asked after the type MRC. So this is how you will get the actual value. So this is how we do what? Discounting. Find the discounting, that is time value of money. Next is what? The cost of equity. So cost of equity again, how do we write? KE, KEE, cost of equity, KU, cost of capital. So cost of equity is determined by the risk of an asset. So the more risky your project is, the more risky your asset is. So definitely the cost will also be high. So which is the part of its price changes that cannot be reduced by diversifying. So for this we have also learned what? The CAPM model, if you remember. So beta is denoted by B. This is levered beta. So what is RF plus RM minus RF into beta? So this is CAPM model. If you remember, we have done capital asset pricing model to find what? Cost of equity. So this is what? RF, risk free rate. Okay, market value, risk minus risk free rate, and the levered beta, that is the risk. So for financial assets, we use such type of model, that is CAPM model, capital asset pricing model, or arbitrage pricing model. So if you remember, in capital budgeting for international projects, so we have done two examples. Okay, two numericals related to arbitrage pricing model, where the risk free interest rate was given of India, and the risk free interest rate of given, I guess, of US, of any other different country. So two type of numericals we have done in arbitrage pricing model. So everything is related to each other, just the method, just the ways they have been bifurcated. Otherwise, all the things are related to each other. In module B, this we have done, the arbitrage pricing model. Clear? Now, the relative valuation. So, relative valuation means what? If if you have to do the valuation of any company, okay, but the actual valuation is not being possible to find out, then we find the nearest competitors company. Nearest competitors company. Okay, or comparable companies. We find the actual value of, suppose there are two companies, this is company ABC and this is company PQR. Now, okay, suppose if I want to purchase the loss bearing company, we have seen that in special cases of valuation, if any purchaser wants to purchase any kind of company related to intangible assets or a loss bearing company. So let's take an example that ABC company is a loss bearing company. Sorry, PQR is a company that is loss bearing company, and owner of ABC company is looking that in future, okay, if this company, if I can work with this company, so definitely this company will reach to its ultimate target. Okay, they will generate a good income. So this company is now wants to purchase this PQR company, but the actual valuation is not possible of this company. Why? Because this company has realized all of its debts. Okay, all of its assets has been realized. They have only the obligation to pay their liabilities. In this case, what happens to ABC company will compare the value of this company with another company. And let's take an example. Okay, uh, RPF company. Okay, if this company is also the same and this company is also the same, both the working scenario, okay, the loss bearing company, everything is same. So now the value of this company is, let's take an example, okay, uh, 12 crore. So ABC will purchase this particular company at the rate of 12 crore. So it means what, comparing it to the value of similar assets. The company which the similar assets are there, okay, similar type of working condition is there. So the value of that company will be opted to the value of this company. So that is the 12 crore with the value of the PQR company as. It is a valuation method that involves determining the value of an asset such as company by comparing it what to the value of similar assets. So this is relative valuation relies on market based metrics to estimate its real cost. Now, so we have different multiples. Yesterday also we have did, okay, price earning ratio, market price per share, MPS divided by EPS, then enterprise value, EV divided by EBITDA, price to sales, okay, market price divided by revenue price sales, then enterprise value divided by revenue. So these are what, this is the actual valuation of those companies which are being compared to a similar nature company to get the worth of the company. Now, startup firms, the analysis framework in general. So if if any startup funds, if a person wants to purchase any kind of startup firms, now how that person will do the valuation of that company? So first they need to understand what is the current scenario, what is the current situation of that company. Although it is a new company, but still you need to know the current situation of that country, sorry, of that company. After that, you will find the revenue growth estimation. In coming scenario, what are the chances of this company to grow? What is the revenue generate of this company? Okay, how much revenue this company will generate. After that, step three, stable growth associated operating margin estimation. So in this, what happens? The company will see that, okay, if this new company will grow, so it will generate 10% profit. But if this company will grow at a stable position, at a stable rate, so this company will generate only 6%. Now, okay, maximum this company will generate 10, 12%, and the stable rate this company will generate 6%. So as if the company is going down, still they can generate 6%, but not less than that. So that should be the stable growth, should be not less than 6%. It should be at least 6%. Now, estimate reinvestment to generate growth. So in step four, what happens? Okay, if this company has made a huge profit, the startup company has made a huge profit. Now, if this profit is being generated so that they may contribute more to the growth of the company. Estimating reinvestment means the profits which the company has earned, it is being estimated that these profits are being reinvested, okay, to generate more growth. So what is its formula? So expected growth is what? Reinvestment rate. Let's take an example. Reinvestment rate is 2%. Okay. At the rate of 2%, I'm reinvesting. Now, return on capital. Okay. How much return you are getting on capital? Let's take an example, 5%. Okay. So expected growth is what? It is reinvestment rate into return on capital. Now, step five, we will see the risk and discount rates. It is impossible that any company may not gather the risk. Okay. They have to see the risk. They have to manage the risk. They have to assess the risk. First of all, identification of risk is important. Then risk assessment is important. You have identified different risks. After that, you are assessing that these are the risks which are very much harmful for our business. After that, you are using different methods to minimize those risks. Then firm valuation, value of non-operating assets. Mm. After that, in step six, what you will do, okay, you will find the firm valuation value, what with the of non-operating assets. So, what are non-operating assets? Can anybody tell me? Tell me what are non-operating assets. So, basically, non-operating assets, I write NOA is what? These are the assets owned by a company that are not directly involved in the core business, in its core production of goods and services, core operations. Okay, like for example, you can say marketable securities, investment, okay, real estate. So these are what? These are the type of non-operating assets that are not directly related to the production, but still they are included in such categories. Now, estimating equity value per share. Okay, the value of equity with respect to the value of your share per share charges. Now, if the firms are having negative or low earning, then how to value such type of firms? How to do the valuation of such firms if they are having negative or low earning? So, valuing loss making firms. When a company has negative earnings, the reason behind these losses will tell that how to value such business. So, what are the losses? The various options are being given to you. Okay, you have companies facing momentary challenge. Okay, so first of all, you will list out the options which is giving you the negative returns. You will list out those options which are giving the negative earnings. After that, you will see the concerns unique to the company. Okay, is this concern with your company only, or is this the same concern with every company? So you will see the concerns. Now, industry wide or market driven issues. So market is impacting your company. Okay, market conditions are impacting your company. Is this the issue of all the industry, or the market is creating such kind of issues? Now, companies with long term issues, suppose you have prepared your long term issues, but you are not focusing on your short term targets as well. So definitely a time will come that there will be a decrement in your short term issues. If you will focus only on short term, that is also not good. If you will focus only on long term issues, that is also not good. So you have to take, okay, you have to do the balance between both short term and long term scenarios. Now, strategic issues. So there is one case of Kodak, okay, the uh, you will see that how this company fall down, okay, how IBM company fall down. They have the Microsoft has purchased the IBM company. So how they fall down with the strategic issues, they have not formulated their correct strategy, they have not formulated the correct plannings, and in this way, the company those companies who are going at a high level, they have suddenly fall down with its one or two mistake. Again, operating issues, okay, that internally the system is not working, the people are not working properly, okay, they are not working in a proper cooperative way. Okay, one is going this direction, another one is going this direction. Now the company size, the if the size is too small that it cannot retain its growth, if the size is too big that there are less human element that can handle the company, so this is also one of the reasons that may give the negative earning. Now, aspects of inefficiency, that is the you are not having the good relations with your members of the organization, with your you can say supervisors, subordinates. Okay, they are not working in an efficient way, so it lacks efficiency and effectiveness. Now, external limitations, that is the pestle. External factors are impacting the company or the quality of management. That is, the top management is not in a position to take a rational decision. His or her decision is not working properly. He is taking decision on his own. He's not cooperating. He's not gathering everywhere. Okay, so this is how the business fails. If the decision making authority, okay, they if they distribute their authority to everyone, or the distribution or the decision making authority lies with the top management. So here also the issue arises when they lack in such case. So these are the things, okay, which tells how the company may go loss, okay, how they become the loss bearing companies. Now, in such cases, how to value the firm. This is how they have to analyze properly. Okay, so loss will guide that how to value the business. Here, so we have done the most important things related to special cases of valuation. In tomorrow's class, we will start with restructuring, okay, amalgamation, restructuring, mergers, very important topic. So don't miss out, okay. Do join this session, very important tomorrow session. So we'll meet you tomorrow then. Till then, take care, everyone. Goodbye. Keep studying, keep watching, and please do join after 5 minutes for ABM YouTube session.